People ask, will the Fed cut rates in 2026? But that's not the real question. The real question is, will the world force the Fed to cut, or will the Fed be trapped by inflation, politics, and credibility? Because the Fed doesn't just cut rates, it cuts narratives. And in markets, narratives don't move slowly. They move reflexively. Belief changes price, price changes belief. As we begin 2026, the Fed's policy rate sits at 3.50% to 3.75% after the December cut. Federal Reserve, meanwhile, markets are already leaning into the next story. Reuters notes markets are pricing in 2 cuts in 2026. Reuters the HIMS. So we have a tension right away, the Fed's official guidance and the market's imagination. And whenever there is tension between belief and reality, that's where opportunity and danger lives. Today I'll give you 5 scenarios for 2026 rate policy and the specific implications for U.S. stocks, especially the difference between AI megacap versus broader market, U.S. bonds, front end versus long end, and why cuts don't always mean yields fall, the U.S. dollar, and why it can weaken even when the U.S. is strong. And stay until the end. I'll share the one stress indicator I would watch in 2026. Not because it predicts the future, but because it tells you when the regime is changing. Let's begin. Welcome back to the podcast. Today's episode, George Soros, will the Fed cut rates in 2026? 5 scenarios and their impact on U.S. stocks, bonds, and the dollar. A necessary note before we go further. This is a Soros-inspired macro framework, a role play in the style of how a reflexive investor would think. I'm not claiming to be George Soros, and this is educational content, not financial advice. Now, the reason this topic matters is simple. 2026 is arriving after a long period where markets were trained to believe one thing: the Fed will save us. But the dollar had a rough 2025. Reuters reports it fell 9.4% in 2025, its biggest annual drop in 8 years. That's not just a currency move, that's a confidence signal. So in 2026, the Fed is not only managing inflation and employment, it's managing credibility, politics, and market expectations. In December, the Fed cut rates by 25 bps to 3.75%. Federal Reserve. Yet uncertainty didn't disappear. Why? Because the market doesn't price today, it prices the path. And even in the Fed's own projections, there's disagreement. J.P. Morgan Asset Management summarizes the Fed's median path as expecting 1 additional cut in 2026 and another in 2027. But markets, according to Reuters, are already leaning toward 2 cuts in 2026. Reuters. So the setup is clear. If the Fed cuts more than expected, risk assets can surge, dollar can weaken, long bonds can rally unless inflation resurges. If the Fed cuts less than expected, stocks can wobble, the dollar can snap back, yields can rise at the long end unless growth breaks. That unless is where regimes change. Here are the 5 scenarios we'll run. Think of them as 5 worlds that 2026 could become. Scenario 1, the soft landing glide path. Inflation cools gradually, growth slows but doesn't break. The Fed delivers measured cuts, not emergency cuts. This is the cleanest outcome. Scenario 2, sticky inflation, no cuts, or a higher for longer pause. Inflation refuses to die. Services, wages, or supply shocks keep it elevated. The Fed is forced to hold, even if growth complains. Scenario 3, recession, demand break, faster cuts. Labor market cracks, consumption slows, credit tightens. The Fed cuts faster, markets cheer until earnings reality arrives. Scenario 4, stagflation shock. Growth weakens and inflation stays high, an ugly regime. The Fed is constrained, bonds behave strangely, stocks reprice risk. Scenario 5, financial accident, liquidity event. Something breaks, credit event, funding stress, shadow banking shock. The Fed cuts and provides liquidity, but markets become reflexive and violent. In each scenario we'll cover what triggers it, what the Fed does, stocks, who wins loses, bonds, front end versus long end, dollar, why it strengthens or weakens. And throughout, I'll repeat one principle. Markets don't move on reality. They move on the difference between reality and expectations. That is reflexivity in one line. At the end, I'll give you the one indicator I'd watch in 2026. Not CPI, not one jobs report. An indicator that tells you whether you're in a normal cycle or entering a new regime. Because in my experience, people lose money not because they're wrong about direction, but because they're wrong about the regime. All right, in part 2, we set the chessboard. Where policy stands today, what's priced into markets, and the Soros-style way to think about the Fed, not as a predictor, but as a player trapped between narratives. Let's go. Before we talk about rate cuts in 2026, we must do something professionals do and amateurs skip. We set the chessboard. Because markets don't move on events, they move on surprises, the gap between what people believe and what actually happens. And in early 2026, that gap is already visible. As we enter 2026, the Fed funds target range is 3.5% to 3.75%, after the Fed's December 2025 quarter-point cut. But more important than the cut itself is the tone around it. The December meeting minutes show a deeply divided committee and caution about going further without clearer data. Some participants argued rates might need to stay unchanged for some time, so the Fed has already given you a clue. This is not an easy money pivot. It's a cautious adjustment, and markets have their own clue. They are still trying to price the path, not the press conference. Here's the tension. The Fed's updated projections point to only one cut in 2026, but market pricing has leaned toward 2 cuts in 2026. That difference matters because it creates a reflexive setup. If the economy softens, markets will pull the narrative toward more cuts. Risk assets may rally first. If inflation stays sticky, the Fed will resist. Markets may reprice violently. This is why I don't ask, will the Fed cut? I ask, which side, Fed credibility or market desire, will be forced to surrender? Now look at the dollar. Reuters reports the dollar fell 9.4% in 2025, its biggest annual drop in 8 years, and started 2026 on a soft note. Reuters. This is not just about FX traders. A weakening dollar can be a symptom of narrowing rate differentials, concerns about fiscal deficits, trade tensions, and most dangerously, confidence in institutional independence. And in early 2026, Fed independence is not a theoretical topic. It is in the headlines, with political pressure and chair succession becoming part of the macro narrative. That matters for rate cuts because the Fed's room to cut is partly a confidence function. When credibility is questioned, the cost of easing can rise. Let me tell you how I approach 2026. I assume fallibility. My forecast can be wrong. So I do not build one prediction, I build scenarios. I assume reflexivity. Beliefs change prices, prices change beliefs, and that loop can drive markets away from fundamentals, especially around policy. And most important, I assume regimes change. In one regime, inflation is a fading problem and cuts support growth. In another, inflation is sticky, term premium rises, and cuts don't help the long end. In another, something breaks, liquidity dominates fundamentals. So our job in this episode is not to call the exact number of cuts. Our job is to recognize which regime we're entering early before the crowd agrees. In 2026, the Fed is constrained by 3 forces. 1. Inflation progress, or lack of progress. The minutes show concern that progress toward the 2% goal may be stalled, which makes further cuts politically and institutionally expensive. If inflation reaccelerates through wages, services, supply shocks, or tariffs, cuts become harder. 2. Labor market reality. The Fed cut partly to stay forward-looking, as job growth slowed and unemployment drifted higher in the narrative of that meeting. If labor weakens sharply, cuts become more likely. But markets won't react in a single direction. We'll unpack why in scenarios 3 and 5. 3. Politics, deficits, and independence. Reuters points to fiscal deficit worries, trade war tensions, and Fed independence concerns as part of the dollar story. These are not side issues anymore. And the leadership transition adds uncertainty about the reaction function going forward. When those constraints tighten, the Fed can cut and still fail to loosen financial conditions the way people expect. Now I want to prevent the biggest beginner mistake. People hear rate cuts and assume stocks up, bonds up, dollar down. Sometimes yes, sometimes no, because the reason for the cut matters more than the cut. If the Fed cuts because inflation is cooling and growth is stable, that's supportive. If the Fed cuts because demand is breaking, earnings risk rises, credit spreads can widen, and stocks can fall even as rates fall. If the Fed cuts under political pressure, the dollar can weaken in a disorderly way, and long yields can rise from term premium, a loss of trust, even as the front end rallies. So in this podcast, we will separate front-end rates, policy expectations, from long-end yields, growth plus inflation plus term premium plus confidence. That separation is where most mistakes are made. Here's the map we'll use for every scenario. Stocks. We won't talk about the S&P like it's one thing. We'll split it into long-duration growth, mega-capped AIs, high multiple, cyclicals and value, profits tied to the real economy, defensives, cash flow resilience, and credit-sensitive equities, small caps, highly levered business models. Because rate cuts can lift valuations while simultaneously destroying earnings expectations. That's how you get whiplash. Bonds. We'll split bonds into front-end, 2-year behavior, pricing the Fed path, long-end, 10 to 30-year behavior, pricing regime plus term premium. This is where Fed cuts but long yields don't fall becomes possible. Dollar. We'll focus on interest rate differentials, growth differentials, risk sentiment, safe haven bid, and confidence, hedging flows, institutional credibility. This is why the dollar can weaken in a risk-on environment but strengthen in a stress regime. Remember the open loop, the one indicator I would watch in 2026. It's not a single CPI print. It's not one payroll report. It's a regime indicator, something that tells you when the system is becoming fragile. Hold that thought. All right, the chessboard is set. Now we go scenario by scenario. In part 3, we start with scenario 1, the soft landing glide path, the cleanest outcome, and also the one most people overpay for when it's already priced in. We start with the cleanest scenario because it's the one people want to believe. Scenario 1, the soft landing glide path. In this world, nothing breaks, nothing explodes. Inflation cools gradually, growth slows gently, and the Fed cuts carefully, not in panic. And this is important. The Fed is already in easing mode after cutting to 3.75% in December. But the Fed is also divided and cautious about cutting too far too fast. So soft landing isn't easy money, it's controlled descent. Now, what must be true for this scenario to happen? For a soft landing, you need 3 conditions at the same time. Inflation continues to drift down, not necessarily to 2% immediately, but enough that the Fed can cut without losing credibility. The minutes show concerned progress toward 2% could be stalling, so this condition matters. Labor cools but doesn't break. Not mass layoffs, not unemployment surging, just slower hiring, softer wage pressure, and a steady but not collapsing consumer. Recent coverage around the minutes highlights unemployment around the mid-4% range, which is consistent with cooling rather than crisis. Financial conditions remain functional. No funding shock, no credit event, no sudden seizing. And yes, minutes discussion has included attention to money market liquidity and funding stress risks, which tells you the Fed is watching plumbing, not just CPI. If those 3 hold, the Fed can keep cutting gradually and claim victory. We managed inflation without recession. But markets don't pay you for what happens. They pay you for what's surprising relative to expectations. So next question, what would the Fed actually do? In this scenario, the Fed behaves like an institution protecting credibility. It signals patience and moves slowly. The December minutes show some officials preferred keeping rates unchanged for some time. The Fed's own projections have pointed to only 1 cut in 2026, while markets have priced closer to 2 cuts. So in scenario 1, the glide path is usually something like 1 cut, maybe 2 if inflation behaves and labor softens a bit more, but not an aggressive easing cycle. The subtle point, soft landing cuts are not rescue cuts, they're tuning cuts. And that creates a very specific market reaction. In a soft landing, stocks can rise for a simple reason. Discount rates fall modestly while earnings don't collapse. But the index is not one organism. It's a zoo. Here's how I'd break it down. A. Mega-cap long-duration growth, AI, high multiple leaders. These names benefit when rates drift down because future cash flows get discounted less. But here's the reflexive trap. If everyone already believes cuts equals tech up, then the trade can become crowded. In scenario 1, mega-cap can still do well, but the upside can be less explosive than people expect because so much optimism is already priced. B. Broad market, cyclicals, value. Soft landing is often better for the forgotten parts of the market. Industrials, quality cyclicals, selective financials, profitable mid-caps with reasonable valuations. Why? Because a gentle easing improves financing conditions without signaling a recession. C. Small caps, rate sensitive, credit sensitive. Small caps can benefit if the cost of capital declines and credit spreads stay calm, but only if the soft landing is real. If credit tightens, small caps suffer first. We will treat that in scenarios 3 and 5. D. The hidden risk. The earnings mirage. Soft landing markets can become complacent. People extrapolate stable earnings forever. So in this scenario, I'm less interested in everything up. I'm interested in rotation and selectivity. Soros-style translation: the best opportunities often appear where the crowd is underpositioned, not where the crowd is already celebrating. Most people think Fed cuts, bond yields fall. Sometimes, but bonds have two personalities. A. The front end, 1 to 3 years. The front end is basically a referendum on the Fed path. In scenario 1, front-end yields tend to drift lower because cuts are gradual and uncertainty declines. This is the clean bond rally. B. The long end, 10 to 30 years. The long end is where people get hurt because it is not just about the Fed. It prices long-run inflation expectations, growth expectations, and term premium, confidence plus fiscal supply of treasuries. In a soft landing, long yields can fall, but they don't have to fall much. Why? Because if investors worry about deficits, treasury supply, or confidence, the long end can stay sticky, even while the Fed cuts the front end. And the recent dollar narrative includes fiscal deficit concern and independence anxiety. Both can feed term premium. So in scenario 1, a common curve shape is front end down, long end down a little, or sideways, which can mean the curve steepens gently. That's important. The bond market can be saying, yes, short rates are coming down, but I'm not convinced about long-term stability. Soft landing is fragile because it requires balance. It breaks in two main directions. Break number 1, inflation reaccelerates. Scenario 2, services inflation stays sticky. Wage pressures reappear, tariffs, supply issues pass through to prices. Then the Fed pauses, the long end can rise, and the easy glide becomes higher for longer. Break number 2, growth cracks. Scenario 3 or 5. Unemployment rises faster than expected, credit spreads widen, something in funding markets breaks cyclicals. Then the Fed cuts faster, markets might rally for a moment, then confront earnings and credit risk. And this is why I keep repeating the same line. Rate cuts are not bullish or bearish by themselves. The reason for the cuts determines the trade. Let me end this scenario with a professional question. If soft landing is the story most people want, how much of it is already priced? Because your edge is not in repeating consensus. Your edge is in identifying what consensus is ignoring. In part 4, we go to scenario 2, sticky inflation higher for longer, and why that scenario can be painful for both stocks and bonds in ways people underestimate. Now we move to the scenario the market hates, because it feels like a betrayal of the cuts are coming story. Scenario 2, sticky inflation higher for longer. This is the regime where the Fed can't cut the way markets want, not because the Fed is stubborn, but because inflation refuses to cooperate. And we already have the seed of this scenario in the Fed's own language. Officials have warned that progress toward 2% could be stalled, and some argued rates may need to remain unchanged for some time. So scenario 2 isn't a fantasy, it's a live possibility. Let's define it. Sticky inflation is not usually one dramatic spike. It's a slow refusal. It shows up as services inflation stays high, the slow inflation, wages remain firm or reaccelerate in pockets. Supply-side shocks reappear, shipping, energy, geopolitics, tariffs, trade tensions add cost pressure, financial conditions ease too much too soon, markets rally, credit loosens, demand stays strong, and inflation stops falling. And in a reflexive world, the last point is critical. If markets believe cuts are coming, they ease conditions before the Fed cuts. That easing can keep inflation sticky, forcing the Fed to pause. This is reflexivity. Belief, market easing, demand stays strong, inflation sticky, Fed resists, belief breaks. And the Fed is already signaling sensitivity to this dynamic by emphasizing caution and internal disagreement. In scenario 2, the Fed doesn't necessarily hike. It simply does not cut as much as the market hopes. This matters because the Fed's projected path has been closer to one cut in 2026, while markets have leaned toward 2 cuts. So scenario 2 is the world where the Fed stays nearer its own path, and the market has to reprice the fantasy. Mechanically, the Fed's behavior looks like language that repeats data-dependent, still restrictive, not declaring victory, longer pauses between cuts, a policy stance that remains tight enough to keep demand from reigniting inflation. And if political pressure rises, the Fed becomes even more sensitive to credibility, because easing into sticky inflation risks looking captured. Scenario 2 is painful for stocks, not because earnings instantly collapse, but because valuations reprice. When inflation is sticky, the discount rate stays high, and when the discount rate stays high, high multiple assets become fragile. A. Mega-cap long-duration growth. In Scenario 2, the market becomes less forgiving of long-duration narratives. Multiples compress, leadership narrows, good companies can still fall because the price you pay matters with all. This is where people learn a hard lesson. A great business can be a bad stock at the wrong valuation. B. Cyclicals, value, pricing power. Some businesses can survive sticky inflation better, especially those with pricing power, strong balance sheets, and real cash flows today. But even here, the market can become selective. It rewards quality balance sheets and punishes leverage. C. Small caps and credit-sensitive equities. This is where damage can concentrate. Higher for longer means refinancing stays expensive, weaker balance sheets feel pressure, defaults can rise at the margin, so small caps can underperform, not always immediately, but persistently. D. The reflexive trap. The market rallies on hope, then reality arrives. In Scenario 2, you often get a pattern. One soft inflation print, rally, one hot inflation print, sell-off, repeat. It's volatility driven by narrative, not fundamentals. Professionals don't need to predict each print. They position for the regime. Higher for longer means less tolerance for valuation excess. Scenario 2 is where the bond market can become counterintuitive. A. Front-end, 2-year area. If the market was pricing 2 cuts and now believes it gets 0 or 1, the front end can sell off, yields can rise, because the front end is basically the market's estimate of Fed policy. This is the mechanical repricing of disappointment. B. Long end, 10 to 30 years. The term premium problem. Here's the bigger issue. Sticky inflation can lift the long end because investors demand compensation for inflation uncertainty and policy credibility risk, term premium. And the dollar narrative has already included concerns about fiscal deficits and independence. So in Scenario 2, you can get yields up at the long end even if growth doesn't look great because inflation risk supplies confidence push term premium higher. This is where bonds always protect you becomes a dangerous simplification. In sticky inflation regimes, bonds can be a source of volatility. It's curve shape. A common curve outcome is front end reprices upward, less cuts. Long end also stays elevated, term premium. The curve can remain steep or even steepen bearishly. In plain English, both ends can hurt you, just for different reasons. In Scenario 2, the dollar often strengthens, at least initially, because U.S. rates stay higher for longer rate differentials, support the dollar. Global capital seeks yield and safety. However, there is a second layer. If higher for longer exists alongside doubts about fiscal discipline or institutional independence, the dollar can become more complex, sometimes strong on rates, sometimes pressured by confidence headlines. So the dollar path can look like near-term strength, rate support, periodic episodes of weakness, confidence shocks, high sensitivity to political and fiscal narratives. The key is, FX becomes a credibility market in this regime. Scenario 2 breaks in 2 directions. Exit A, disinflation returns back toward Scenario 1. If inflation finally softens convincingly, especially in services, the Fed regains room to cut without risking credibility. Then the soft landing glide path becomes plausible again. Exit B, something snaps toward Scenario 3 or Scenario 5. Higher for longer is stress. Stress accumulates in weaker borrowers, commercial real estate pockets, refinancing walls, funding markets. If credit spreads widen or a funding shock appears, the Fed may be forced to cut. Not because inflation is solved, but because the system is breaking. And that is a very different kind of cut. That's why I said earlier, the reason for the cut matters more than the cut. Let me summarize Scenario 2 in one line. Sticky inflation forces the Fed to disappoint the market, and disappointment is a powerful market mover. In this regime, valuation becomes a weapon, leverage becomes a liability, and term premium becomes the hidden tax. In Part 5, we go to Scenario 3. Recession, demand break, faster cuts, the world where the Fed cuts more and yet stocks may not celebrate for long. Now we move to the scenario where people hear one word, cuts, and assume it's bullish. But this is the Soros lesson. Cuts can be an anesthetic or a signal that the patient is in trouble. Scenario 3, recession or a clear demand break. The Fed cuts faster than expected because the economy forces it. And remember our starting point. The Fed ended 2025 by cutting the funds rate to 3.5 to 3.75%. Federal Reserve markets have been leaning toward more easing in 2026 than the Fed's own median suggests. So in this scenario, the market gets what it wants, more cuts. But the reason is ugly. Let's define the triggers. A recession regime usually begins quietly, then suddenly becomes obvious. The triggers look like this. Labor market cracks, hiring slows into layoffs, unemployment moves faster than people expected. Consumers become cautious, not by choice, by necessity. Credit tightens and spreads widen. Not necessarily a 2008-style collapse, just enough widening that marginal borrowers can't refinance, and activity slows. The consumer breaks at the margin, delinquencies rise, big-ticket spending pauses. Confidence collapses because cash flow becomes the story. Corporate earnings guidance turns defensive. This is key. Markets often rally on the first cut and then roll over when earnings reality arrives. In a recession scenario, the question is not will the Fed cut? It is, will the Fed cut fast enough to stop a self-reinforcing downturn? Because recession is reflexive too. Slower demand, layoffs, less spending, more layoffs. In scenario 3, the Fed shifts from tuning to support. It cuts more than the soft landing crowd expected, potentially multiple times across the year, because the mandate forces action. But here is where many investors misunderstand the Fed. The Fed doesn't just cut rates. It tries to stabilize financial conditions and expectations. So in this scenario, the Fed will likely do 3 things. Cut faster than in scenario 1. Signal readiness to do more if needed. Emphasize stability, because confidence is part of policy transmission. And the Fed will be doing this while still carrying the credibility scar of inflation battles. Minutes already showed the committee is cautious and divided about cutting too much in uncertain conditions. So even in recession, the Fed's communication matters. It must look responsive without looking captured or reckless. This is where amateur thinking gets punished. They think, rates down, stocks up. Professionals ask, rates down because what is breaking? In recession regimes, the market often moves in phases. Phase 1, the relief rally. When the Fed starts cutting faster, risk assets can rally, especially long-duration growth, because discount rates fall and narratives shift. Phase 2, the earnings wall. Then fundamentals arrive. Revenues slow, margins compress, guidance drops, default risk rises at the edges, credit spreads widen, and stocks can fall even while rates fall. This is the most confusing environment for the public. Now, segment by segment. A, mega-cap, long-duration growth. These can rally first on falling yields, especially if investors see them as quality duration. But if recession deepens, even winners can become sources of liquidity as people de-risk. B, cyclicals and economically sensitive sectors. These often suffer because their earnings are directly tied to demand. C, defensives and quality balance sheets. In recession, the market starts paying for cash flow stability, low leverage, pricing power, resilient demand. The word is survivability. D, small caps and leveraged equities. This is where recessions can be brutal. Small caps are more credit sensitive, more refinancing sensitive, and less able to absorb margin pressure. So in scenario 3, your key equity question is, am I holding stories or am I holding balance sheets? Because recession punishes fragile narratives. In scenario 3, bonds become more interesting because the Fed path changes quickly. A, front end, 1 to 3 years. The front end tends to rally when the Fed cuts faster than expected. That's the mechanical repricing of policy. This is the cleanest expression of faster easing. B, long end, 10 to 30 years. The long end is more nuanced. In a clean recession, disinflation returns, credibility intact, long yields can fall meaningfully, classic bond rally. But in a messier recession, confidence issues, fiscal stress, supply concerns, the long end may not fall as much as people expect. Why? Because long yields price not just growth. They price inflation risk, term premium supply, and confidence gains. So recession can produce a split outcome. Front-end yields fall quickly, while long-end yields fall less or even get sticky. Soros-style translation: even when you're right about direction, you can be wrong about the instrument. In recession regimes, the dollar often has a two-step dance. Step 1. Risk-off strength. When global markets fear recession, capital runs toward liquidity and safety. The dollar can strengthen, especially against risk currencies, because it remains the deepest pool. Step 2. Rate differential reversal. If the Fed cuts faster than other central banks or faster than expected, rate differentials narrow and the dollar can weaken later. And in 2026, the dollar is already coming off a weak 2025. Reuters noted a 9.4% drop, and markets are sensitive to the rate cut path. So in scenario 3, the dollar path can be stronger on fear, weaker on aggressive easing, and narrowing yield advantage. This is why FX is not a one-variable trade. It's a regime signal. Let me summarize scenario 3 in one line. The Fed cuts faster, the front end rallies, the dollar may spike on fear, yet equities can still struggle because earnings and credit become the real story. In part 6, we go to scenario 4, stagflation shock. The regime investors fear most because it breaks the simple playbooks for both stocks and bonds. Now we enter the regime investors fear most because it breaks the simple playbooks. Scenario 4, stagflation, slower growth and persistent inflation. In a normal cycle, the Fed can choose, fight inflation or support growth. In stagflation, the Fed is trapped because easing risks reigniting inflation and tightening risks crushing a weakening economy. And in early 2026, we already see the ingredients of constraint. The Fed cut to 3.50 to 3.75% in December, but internal divisions and concerns about stalled progress toward 2% inflation are very real. Meanwhile, the dollar entered 2026 soft after a sharp 2025 decline, with political fiscal narratives in the background. Stagflation is where confidence becomes a macro variable. Let's define the triggers. Stagflation doesn't usually start with a normal demand boom. It starts when supply-side inflation returns while demand is already tiring. Common triggers in this regime: energy shock, oil, gas, shipping, anything that ripples into transport and production costs, trade friction, tariffs, supply chain re-stress. Costs rise, but growth does not accelerate. You get inflation pressure without prosperity, and trade tension has been part of the narrative weighing on markets and the dollar. Services plus wage persistence. Even if goods inflation cools, services inflation can stay sticky due to wage dynamics. Productivity disappointment. If productivity underdelivers, unit labor costs stay elevated. Again, inflation pressure without healthy growth. So the stagflation recipe is simple. Costs up, real growth down, confidence fragile. That combination forces the Fed into a credibility problem. In stagflation, the Fed's best move is often an unpleasant one. Pause, communicate discipline, and tolerate pain. Why? Because cutting into stagflation can weaken the dollar and reignite inflation expectations. And if inflation expectations unanchor, long-term yields can rise, even if growth is weak. The Fed's December posture already hinted at this constraint. Minutes coverage describes significant division and unease about cutting further without clearer progress on inflation. So in scenario 4, the Fed likely avoids aggressive cuts, leans on language, restrictive, data-dependent, credibility, tries to prevent financial conditions from easing too much. But the market is reflexive. If investors think the Fed is trapped, they start pricing risk differently across stocks, bonds, and the dollar. Stagflation is not everything crashes equally. It's a regime of brutal differentiation. Here's how it usually plays. A. Long-duration growth, high multiple narratives. These suffer because discount rates stay high or rise at the long end, earnings visibility declines, and the market stops paying for distant promises. In stagflation, the market demands cash flow now. B. Cyclicals tied to real demand, also vulnerable because growth slows. You get pressure on volumes and margins at the same time. C. Pricing power and real asset exposure. This is where relative winners can appear. Businesses that can pass costs through companies tied to commodities, energies, materials. Depending on the shock, select defensives with resilient demand. The key word is pricing power. D. The hidden landmine, leverage. Stagflation is where leverage becomes toxic. Refinancing stays expensive, growth slows, margins get squeezed, defaults rise at the edges. Smober. So in this regime, you don't ask, is it a great company? You ask, can it survive higher costs, weaker demand, and expensive capital simultaneously? That's a balance sheet question. Stagflation is where bonds can disappoint people who learned only one lesson. When growth slows, buy duration. Because in stagflation, growth slows, but inflation risk stays alive. A. Front end, policy sensitive. If markets believe the Fed is trapped and won't cut as much as hoped, the front end may not rally much. It can be choppy, pulled between weak growth, bullish, and sticky inflation, bearish. B. Long end, term premiums, inflation expectations. This is the problem area. If inflation risk rises and confidence weakens, investors demand higher compensation, term premium, so you can get the ugly outcome. Growth is weak, yet long yields don't fall much or even rise. That is stagflation's signature. It breaks the hedging relationship people rely on. And if the dollar's credibility is questioned, remember the concerns about deficits, trade tensions, and Fed independence in the market narrative, term premium can become even more unstable. Soros-style translation: when confidence becomes a variable, duration stops being safe by default. In stagflation, the dollar can behave in two competing ways. Force 1, risk-off safe haven, dollar up. If global risk sentiment collapses, the dollar can strengthen simply because liquidity is preferred. Force 2, credibility, inflation anxiety, dollar down. If markets fear the Fed is constrained and inflation could persist, confidence can weaken, especially when fiscal and political narratives are already sensitive. That's why in scenario 4, I don't predict dollar up or dollar down as a single line. I predict volatility and regime sensitivity. And for investors, FX volatility is not a sideshow. It feeds back into inflation and financial conditions. That's reflexivity again. Stagflation ends in one of two ways. Exit A, the supply shock fades, energy normalizes, trade pressures ease, supply chains improve, inflation drifts down, and the Fed regains freedom of action. That pushes us back towards scenario 1. Exit B, the Fed or the economy breaks demand. Policy stays tight long enough that demand collapses. Inflation eventually falls because growth is crushed. That pushes us towards scenario 3, or even scenario 5 if something snaps in credit or funding. This is why stagflation is the most dangerous scenario. It forces hard choices, and hard choices create accidents. Let me summarize scenario 4 in one line. Stagflation punishes duration and leverage at the same time, and it turns credibility into a tradable variable. In Part 7, we go to Scenario 5. Financial accident, liquidity event. The world where something breaks in the plumbing and the market stops caring about forecasts and starts caring about cash. And then, after Scenario 5, I'll finally reveal the one regime indicator I would watch in 2026, the one that tells you whether you're in a normal cycle or entering a fragile system. Now we arrive at the scenario that makes forecasts irrelevant. Scenario 5. A financial accident, a liquidity event. Something breaks in the plumbing. This is the regime where the market stops caring about your view on CPI, GDP, or even the exact number of rate cuts. Because the only question becomes, who needs cash right now? And if you think this is unlikely, notice what the Fed itself has been watching. December minutes coverage shows policymakers focused on whether the system has enough cash to avoid sudden disruptions. Reuters reported the Fed judged reserves were in the ample range and began Treasury bill purchases, reserve management purchases, explicitly to support smooth market functioning, not to change the stance of policy. That's a quiet admission. Liquidity conditions matter, and they can tighten faster than headlines suggest. So let's define the accident. A financial accident usually doesn't start with a big villain. It starts with a small crack that becomes reflexive. Typical trigger paths: A. Funding stress in short-term markets. Repo rates jump, overnight funding becomes spiky, and dealers pull back. Quarter ends can amplify this because balance sheets tighten mechanically, something the Fed itself has analyzed in detail, including how spreads like SOFR versus ONRRP behave around quarter ends. B. Reserve scarcity / cash distribution problem. Reserves in aggregate may be ample, but the distribution can be uneven, and that's where accidents happen. Reuters' report on reserve management purchases highlights staff concern that reserves were no longer abundant and could be strained by predictable drains like tax payments, and that bill purchases were meant to maintain rate control and market functioning. C. Treasury market liquidity suddenly deteriorates. Bid-ask spreads widen, depth disappears, and the safest market in the world becomes hard to trade at size. The New York Fed has tracked how Treasury liquidity metrics behave during 2025 volatility and policy uncertainty. D. Credit spreads gap wider. A refinancing wall appears, defaults rise at the margin, and credit becomes the transmission channel. Now here's the reflexive mechanism. Funding stress, forced selling, volatility rises, liquidity providers step back, more stress, more forced selling. That loop is why accidents move faster than your brain can process. In Scenario 5, the Fed will likely respond in 2 layers. Layer 1. Monetary policy, rate cuts. Yes, the Fed can cut rates fast, but rate cuts are not the primary tool for plumbing stress. Layer 2. Liquidity operations, the real battlefield. This is where the Fed acts to keep markets functioning. Reserve management purchases like Treasury bill buying, repo operations, standing facilities, messaging that distinguishes market functioning from stimulus. Reuters was explicit. The bill purchases were framed as maintaining smooth market functioning and interest rate control, not changing the monetary policy stance. This distinction matters because it changes how you trade the event. A rate cut can lower the cost of capital. A liquidity operation prevents the system from freezing. In a true accident, plumbing dominates macro. Equities in a liquidity event move in phases. Phase 1, forced selling, risk-off liquidation. Everything correlated sells because investors raise cash, de-risk, meet margin calls, and reduce VAR. The worst hit tends to be highly levered companies, unprofitable growth, small caps, and credit-sensitive equities, crowded trades. Phase 2, policy response bounce, liquidity relief rally. When the Fed intervenes, the market can reverse violently because positioning becomes one-sided. But here's the Soros-style warning. The rebound is not the all-clear. It's the reflexive snapback. Phase 3, the new leadership regime. After the bounce, the market begins pricing survivability. Winners tend to be fortress balance sheets, essential cash flows, businesses with pricing power, companies that are liquid safe equities, often mega-cap quality. Losers tend to be refinancing-dependent business models, fragile credit structures, anything that requires capital markets to stay friendly. Key takeaway. In Scenario 5, the index can recover while many stocks never do. Dispersion is the signature. In accidents, bonds also move in phases. A. Front-end, policy expectations, typically rallies hard because the market prices rapid easing. B. Long-end, confidence plus liquidity's term premium. This is where people get surprised. In a classic flight to safety, long yields fall. But if the accident is tied to Treasury market liquidity issues, fiscal term premium anxiety, or credibility questions, then the long end can behave in a less clean way. The New York Fed's work on Treasury market liquidity shows how volatility and uncertainty affect liquidity conditions. In an accident, those relationships intensify. Depth can vanish when volatility spikes. So in Scenario 5, you can see front end down sharply, long end down less, or erratic curve behavior that reflects policy relief versus confidence risk. Soros-style translation. In accidents, the safest asset can become hard to trade, temporarily, and that changes price behavior. The dollar in accidents usually has a 2-step pattern. Step 1, dollar strength, global dash for safety. Cash is king. The dollar is the global cash. Step 2, dollar weakness, policy response plus narrowing differentials. If the Fed eases aggressively and liquidity floods the system, the yield advantage can shrink and the dollar can soften. And you must overlay 2026's sensitivity. The dollar entered 2026 weaker after a sharp 2025 decline, with markets pricing cuts and narratives around deficits and Fed independence in the background. So in a liquidity event, FX can become volatile. Fear strengthens USD policy, softens USD confidence, headlines can swing it sharply. Now I'll pay off the open loop. If you only watch one thing in 2026 to detect a regime shift early, don't watch the headlines, watch the plumbing. Specifically, indicator, short-term funding stress relative to Fed backstops. A practical version is monitoring spreads and spikes in overnight funding, like so far, relative to the Fed's administered backstops, ONRP, especially around quarter ends and stress windows. The Fed has analyzed these quarter-end repo dynamics directly and pair it with reserve scarcity signals. The Fed is already responding to reserve dynamics with Treasury bill purchases aimed at maintaining ample reserves and smooth rate control. And you can observe the system's shock absorbers through public data, like the Fed's overnight reverse repo usage series. How to interpret it? Simple. If funding rates and spreads stay calm, you're likely in scenarios 1 to 3, macro-driven. If funding rates start spiking, plumbing facilities get stressed, and the Fed leans harder on bill purchases/operations, you're drifting towards scenario 5, liquidity-driven. Why this matters? Because liquidity regimes can make good macro calls irrelevant in the short run. If you detect the regime early, you stop fighting the tape and start surviving. So scenario 5 is the world where the Fed cuts, but plumbing matters more than policy stocks whip violently. With dispersion and survivability, pricing bonds don't behave in a textbook way, and the dollar becomes a fear and policy tug-of-war. In the next part, I'll deliver the final wrap. A clean comparison table of all 5 scenarios, what to watch, what tends to outperform, a positioning logic summary for stocks, bonds, USD, and the closing message, how to think like a reflexive investor in 2026 without overtrading. All right, we've walked through 5 worlds. Now we do what professionals do at the end of scenario analysis. We reduce complexity into a usable map. Because in 2026, you won't win by predicting one perfect outcome. You'll win by recognizing which regime is emerging before the crowd fully adjusts. And remember the starting tension. The Fed ended 2025 with the policy rate at 3.75%. Market pricing has leaned toward 2 cuts in 2026, while the Fed's own path has been closer to 1. That gap is the fuel of volatility. So here's the map. Scenario 1. Soft landing glide path. Inflation cools gradually, growth slows gently, system stays stable. Fed cuts slowly. Markets rotate rather than explode. Scenario 2. Sticky inflation. Higher for longer. Inflation refuses to fade. Fed pauses or cuts less than the market wants. Valuations compress. Long yields can stay sticky. Scenario 3. Recession. Demand break. Growth cracks. Fed cuts faster. Front-end rallies. Dollar can spike on fear. Equities can hit the earnings wall. Scenario 4. Stagflation. Shock. Costs rise while growth weakens. Fed is constrained. Bonds can disappoint as a hedge. Stocks reward pricing power and balance sheets. Scenario 5. Financial accident. Liquidity event. Plumbing stress. Forced selling. Fed liquidity tools dominate. Violent moves, dispersion, survivability becomes the only language. Now let's turn that into an actionable framework. Think of this like a radar screen. You don't need 50 indicators. You need a few that tell you which world is forming. Scenario 1. Soft landing. Signals inflation cooling without sudden shocks. Labor softening but stable credit spreads. Calm funding markets calm. Scenario 2. Sticky inflation. Signals inflation progress stalls. Fed concern is already visible in minutes coverage. Services wages remain firm. Long-end yields remain elevated. Term premiums sticky. Dollar firm on higher for longer, with periodic confidence headlines. Scenario 3. Recession. Signals unemployment rises faster than expected. Earnings guidance turns defensive. Credit spreads widen. Consumer stress increases. The Fed begins to move faster than its prior guidance. Scenario 4. Stagflation. Signals inflation pressure returns via supply, energy, trade. Growth momentum weakens. Long yields don't fall, even as growth slows. FX volatility increases as confidence becomes a variable. Scenario 5. Accident. Signals funding rates spreads spike. Liquidity metrics worsen. Stress around quarter-end funding conditions. Fed has analyzed these dynamics directly. Fed increases plumbing focus. Reserve management purchases are already part of the toolkit. And that leads to our one indicator again. Watch the plumbing. Funding stress plus reserve scarcity signals. Because macro can be wrong for months, but plumbing doesn't lie when it's stressed. This is not investment advice, it's scenario logic. Scenario 1. Soft landing. Stocks, broadening participation, rotation into quality cyclicals and reasonable growth. Bonds, front-end rallies modestly, long-end stable to slightly lower. Dollar, gentle weakening as differentials narrow and risk appetite improves. Scenario 2. Sticky inflation. Stocks, pressure on high multiples, preference for cash flows and pricing power. Bonds, front-end reprices, fewer cuts. Long-end sticky via term premium. Dollar, tends to firm on higher for longer but watch credibility headlines. Scenario 3. Recession stocks. Initial relief rally possible, then earnings credit dominate, defensives and quality balance sheets favored. Bonds. Front end rallies strongly, long end depends on confidence versus classic flight to safety. Dollar. Often up first on fear, then down as easing accelerates. Scenario 4. Stagflation. Stocks. Pricing power plus real assets plus survivability. Narratives. Bonds. Hedging relationship weak, long end can be unstable. Dollar. Volatile tug-of-war between safe haven and credibility. Scenario 5. Accident. Stocks. Liquidation, policy bounce, dispersion, survivability and liquidity dominate. Bonds. Front-end rallies. Long end can be erratic if liquidity term premium issues arise. Dollar. Spikes on fear, then volatile as policy and confidence collide. Now, I'll give you the mindset framework, the rulebook. Rule 1. Don't worship one forecast. A single forecast is a fragile identity. Scenarios are a resilient strategy. Rule 2. Trade the gap between expectations and reality. Markets move on surprises, not headlines. If markets price 2 cuts and the Fed delivers 1, price moves. If markets price 1 and the Fed delivers 3, price moves. That's why the Fed versus market gap matters. Rule 3. The reason for cuts matters more than the cuts. Cuts from soft landing are supportive. Cuts from recession are defensive. Cuts from accidents are survival operations. Rule 4. Avoid ruined scenarios. Compounding requires survival. Don't blow up on leverage, concentration, or forced selling. Rule 5. Watch the plumbing. If liquidity breaks, your macro view becomes secondary. If you take one question from this episode, take this. Are we in a macro regime or a liquidity regime? If it's macro, growth, inflation, and the Fed path dominate. If it's liquidity, funding stress, forced flows, and survival dominate. That single question keeps you from overtrading, panicking, and chasing narratives. So will the Fed cut rates in 2026? My answer is, it depends on which world arrives. And because the world is reflexive, belief and reality push on each other, the best edge is not prediction. The best edge is regime recognition, early. If you want the next episode, comment A. Portfolio positioning for each scenario, stocks, bonds, D. B. The plumbing dashboard, what to track weekly. C. How to think like Soros, reflexivity and risk, drop A, B, or C. And if this episode helped, share it with one person who keeps asking, what will the Fed do? Instead of asking, what is the market already pricing? Thanks for listening.